What is going on, everybody, and welcome to another weekly update. And what I like to do in these videos is provide you guys some upcoming earnings, some upcoming events to help you get prepared for the week ahead. If that sounds like something you're interested in, consider subscribing as we do provide daily updates as well to get you prepared for the day and the week ahead in this glorious market. So let's kind of just recap last week. Again, wasn't really a lot of events that occurred last week, aside from a couple hot reports that made some intraday moves. But aside from that, what was really fueling the downside last week was a pricing in of a 5.5 rate, or essentially rates topping out in September of this year. Now, the additional rate increase was something that wasn't essentially projected. Essentially, we only had two potential rate increases, not three. We were aiming for five, essentially 5.25. Now we're going for 5.25 to 5.5 coming into this year. And again, I think that's very premature to think that that's just going to be it. But let me continue my thought for last week. So for last week, again, as you can see, the market kind of really picked up at the tail end of the last week. Again, I think that was really a lot of short covering. I thought we would have had a bigger move up in the essentially this whole week because there really wasn't a lot of data. But considering that they were trying to adjust for 5.5, kind of caused a little bit more selling this week. And then again, we had short covering in the back half of the week, essentially, I think, to soften the blow of what's potentially coming. I'm going to pull up this, and there's a reason for this because the next couple of weeks are going to have some very pivotal data and information on what's currently going on. Um, so, as of to this point, I want to talk about this particular point very much so because coming into this year, uh, savings rates were extremely low. I think some of the lowest, if not the lowest. I think it was either the second lowest or the lowest in history. But nonetheless, we have essentially bounced back from that to going from like a 2.4, I believe it was, to currently now we are sitting at a 4.7. So we've almost doubled where we were. But you have to take a lot of things in consideration here. People are selling a lot of assets to potentially build up that personal savings. Uh, and why would I suggest that is because of the fact that you know credit cards are essentially getting maxed out, and we're in the most debt we've ever seen, making new time highs in debt, personal savings debt or personal debt, right? And so, and considering that the rates are so high, that debt that's being carried over month to month is also essentially getting walloped with around 19 to 20% um, rates on those credit cards for that debt that's being carried over month to month. So you're getting walloped there. Energy is high, rentals are still very high. Yes, there's been kind of a down tick slowly. The demand for houses is way down. Seeing some of the lows. The problem with that is to really get a crash in the housing market, you have to have a lot of supply. And right now, we aren't seeing tons of supply, but I think that's only a matter of time. Now, leading up to this, we have seen a uptick um, in some particular areas as far as demand coming back. Now, this is not a good sign because means this leads to more inflation. In why essentially the Fed essentially dropping down a 25-point basis move was probably very premature. Because of the fact, as soon as they let off the gas, now you're seeing demands run back in. So what does that mean? It's going to be inflation is going to start running through the roof again, which is not a good sign. We're getting around to that area where the seasonal wise, right? Inflation will start to rise up into going into essentially the vacation time, right? And so with everything currently going on, uh, things still are not looking better. Some aspects are, but you have to understand that people may be liquidating assets to show or working multiple jobs to keep up with just inflation. Wage growth is still well below inflation. That is a problem. If you're working three jobs just to make ends meet to live, and to live in not a very good place because of the rates being so high that you can't, even if you made well in the six figures as an individual, you're still going to struggle, especially in this economy. And things won't get better quickly. It's not saying that the market can't push up, the market can push up, but nonetheless, there's going to be a lot of defaults. There has been a lot of defaults, and there's been an uptick in defaults, and that's going to continue essentially because of the fact that you're continuing to see more layoffs. Even this week, I've seen a lot more layoffs. I know a lot more other companies are laying off or have projections to lay off by the end of the month, and you are starting to see a lot of different these people that have been on severance packages are starting to roll off these severance packages. So again, my reasoning for this month, you're going to get that natural uptick in some things. We talk about seasonal inflation. We talk about seasonal demand. It does play into account to some things, but I think this month again is going to be a very nasty month. And the pump that we had on Thursday and Friday are to soften the blow on what's to come. So starting out the next 3 weeks, we have Powell. Uh, He gives his testimony for the Senate and the House this week. That's just leading off the week. And then we have the Beige Book on Wednesday and then the non farms on Friday. And this is going to lead into a core next week and then the monetary policy the week after that. So this week, anytime Powell speaks, I've said this many times before, and if you don't know, anytime Powell speaks, he moves markets because what he's doing will affect markets. And so this is why he's been very generalized in a lot of different things that he's said, because if he says something incorrectly, people will take it the wrong way and the market will run one way or another because of what he says. So he has to be very generic on what he says because, again, you have to understand markets are very emotional, right? Every decision people make in investments is an emotional decision. This is why I talk about being neutral a lot, because of the fact that if you can be neutral in any market, then that will allow you to be more objective and allow you to see things more clearly. But it takes time and practice in the markets, right? And so with that being said, nonetheless, we have Powell on Tuesday. Again, something I talked about is I think it was very premature that the Fed came in at 25-point basis move. Now, if he decides to pull away from that and jump to a 50-point basis move, you're going to scare the market. And again, he was very, very dovish the last couple times we've seen him, and that's not good. And normally he's been very hawkish when it comes to when he essentially testifies with the House and Senate. So this being said, Tuesday and Wednesday, Powell is going to get grilled. Why did you go to 25? Do you feel that it's okay for us to let off of inflation? Inflation, we've noticed since that last monetary policy, is starting to get hot again. This is a concern because as soon as you lay off rates, the demand came right back, and that's what we're seeing, and that is a problem. That is an issue. People are selling assets, so yes, their savings are built up because they're potentially anticipating coming forward. And you had a lot of the bank CEOs and everything talking about how recession is essentially coming. One week they're recession, and next week they're soft landing. And the thing is, you can look back in history. Before every recession, they've always talked that it was going to be a soft landing. So that's just trying to put things in perspective. You can look at any recession that there is, and there's always been talk with the recent recessions about how there was going to be a soft landing, and there wasn't. And so the concern here is, this has happened back in the 1979, 1980, when we thought we had control of inflation, and inflation just took off, and then we end up screaming into the 20s for interest rates. Is that going to happen this year? This time around, nobody knows. But the problem is, and one thing that we haven't seen in history is we haven't printed 40% of the money supply. So things can get out of hand very quickly. So just assume that things are going to be okay and just bounce right back is not the case. So nonetheless, Tuesday and Wednesday is going to start out this essentially March. We'll call this March Madness because that's exactly what's about ready to happen. You have Powell. He has to essentially talk about why he's made decisions for a 25-point basis move. Does he feel like he has inflation under control? He will get grilled. That's the nice thing about him being in the House and Senate is he gets grilled and he has to answer these questions. And he's going to try to be generic because it is publicized, or it's public to watch these testimonies, and again, it's going to be out there. It's going to be exposed, and then you're going to follow it up with non-farms, and then again core next week. So if core comes in over 6.5, you're going to get panic, especially if it's back in the sevens. Then it's really going to be an issue because the Fed isn't going to have a choice, but at least a 50-point basis move, if not a 75. Because there's such a delayed reaction in essentially the rate increases, and we've seen that we're going from all those 75-point basis moves. Yeah, we dropped a lot very quickly, but as soon as we hit 50, it started slowing down. So it was a 6.5 to 6.4, the 50-point basis move that we just had. So what happens when we only apply a 25-point basis move? Does that mean it goes back? Inflation goes back in the opposite direction and goes back over 6.5? That's the concern. And so I think that is the way it's going to play out in March. You're going to get this test. You're going to get essentially Powell getting grilled this week, and then next week you're going to have the core. And by God, if the core is over what it's supposed to be, it's going to be a huge problem. I'm going to highlight this. There we go. Okay, so then we got non-farms. Again, non-farms are going to play big into currently what's going on with the core. Again, into monetary policy, but ultimately understand, yes, there's a lot of people that are working and working multiple jobs to keep up with inflation because wage growth just isn't there. You have to be working tons of extra hours to make up for the difference for the average American right now. And so upcoming events, again, we got core next week, and then after that, monetary policy. So that's going to be interesting. We do have the beige book as well this week. So that's going to give us insight into what to expect for the next monetary policy. So we have this week, we'll have Powell getting testimony, and then next week is blackout week for the Fed. So you'll hear a lot of Fed members talking. They're really noisy before they go on the blackout period. Which is surprising because when I look at the expected moves and options this week, it's not very high. So we could make some huge plays on options this week. These are the kind of weeks you want to take advantage of because they're really not anticipating anything big, but you have some very pivotal events this week, especially with Powell, that can change that very quickly. And it's kind of setting up because the market ripped up. You got short covering. So you're getting your premium, you're killing the premium for the sell side into setting up a big week that could be a huge sell week. So just be mindful of that. There's reasons why the market moves as the way it does. It's not clear a lot, but that's why I have this channel to try to clarify what's really going on and what I've seen in my experience in the market. You see a lot of these patterns happen quite frequently. They line up with the events. So as long as you're aware of the events, you can kind of play towards these events. So nonetheless, the beige book is going to give us insight into the next monetary policy. And again, if there's anything stipulated in that beige book about a potential 50-point basis move, you're going to shock the market, and then the odds of 50-point basis move are going to jump. And if that jumps, that's going to take down the market huge. And then if you get non-farms on Friday that show that there's a lot of strength in employment, that just means that the Fed can go ahead and start and continue with the higher rate increases. And that might be essentially the whole theme that is playing out here people are working multiple jobs to try to stay on par with inflation, and inflation starts running away, those 2 or 3 jobs aren't going to keep up. And so that's why people have been building their savings essentially by selling assets. People are selling a lot of the nice to haves right now. That's been going on for a while. And the next thing is homes. Homes is one of the bigger purchases, and then you might see a huge flood of homes, and then that's going to start potentially a big cascading effect that could cause a crash. Right, because you don't have the demand there right now, and so if the demand's not there right now, just because of the rates being so high, the next move would be that, okay, well, you need a massive supply of houses, and to get the massive supply of houses, people have to be in a bad spot, and be a bad spot, more than likely, they're going to have to lose their job, and we're seeing continued layoffs, and we're still not even at the bulk of layoffs. So even by the end of the year, they're still projecting 1 million job losses, and we still haven't even hardly touched uh, that million, right? We still got many more layoffs to come. And so you can see where this can cascade into something really, really bad. And so, nonetheless, that's kind of where we're sitting at. We'll see there. Upcoming earnings. Again, earnings, we're going to reset the clock here. We're about a month out for the next for Q1 earnings, where we start getting banks and your big tech again. That's really my earnings. Those are the earnings to really pay attention to, is like the industry leaders. Once those happen, like the earnings are pretty much done at that point. Not saying that you don't have these individual ones. These are 2 individual ones, are Crowd and MongoDB. I'm really watching these particular ones because I want to see where the AI industry is and where the demand is. And so that's why I want to bring these ones up in particular, just to kind of see. Security is obviously a big one as well, on top of everything. So those are the 2 big ones, is security, um, essentially primarily software security, and for AI are I think the big ones are going to lead us particularly out of this recession. And yes, we've been in a recession for a long time, so much so that I think we're actually in a depression, because after 6 months of a recession, you go into a depression. And so I think we're already at that point. They're not going to tell you that until after the fact of that we have recovered. Again, not to introduce panic. You introduce panic, then you get yourself out of the rut you're in. So you have to try to make it seem like everything's okay by whatever means necessary. And that's what they do, is to make things seem like everything is okay. Um, just to try to help things pass so that they can get things back on track. And then they'll say after the fact, yeah, we were in a depression since, December of 2022, we've been in a depression. And so, again, I still think we have one more solid year before we get out of this depression. I think we can recover. It's not going to be a quick recovery, but I think the interest rates will be high for a long period of time. Anytime you go over 5, it's at least a 10-year span in which those interest rates will stay high. And that's just proven through history. So, this week, we got those 2 upcoming earnings watch list. This is what I'm talking about. SPX is only at 78. And if you watch my channel at all, 78 is close to normal. We've seen some big, huge spikes in SPX at over 100, 110, 120. And now it's at 78. And you got some huge events coming on with Powell. You got some huge events with the Beige Book, and especially projecting what's going to come. Again, if they mention anything about a 50-point basis move in that Beige Book, that's going to be a problem. And then you have non-farms. If we get a strong non-farms report, again, more fuel to potentially why the Fed can hit us with another 50-point basis move. So those are things to watch. And so with that being said, you only have a expected move of 75 points being priced in. And I think if this ducks align, right, you can get some big moves out of that. And considering the average for SPX is roughly around 65-ish. So Tesla, let's see, some of the expected move is starting to come down because it hasn't been so volatile. Had a really bad investor day. Wasn't nothing really exciting. So it's lost some steam. Question is, will it continue to lose steam? BA still somehow showing strength. So is the banks. And then with JPM, NVIDIA, kind of just pushed back and retested that top end. I think this is the last. You get that one last hoorah, let's push to the top, and then the dump happens, and that's what I think this week is going to be a big red week. On top of everything, I think everything's going to play out to where it's going to be like, oops, I think we need to raise this back to 50-point basis move. And then that's going to be the nail in the coffin. That's just going to sink us to new lows. It really depends on how bad that core is. If that core is really bad, it could potentially happen. Right? We've seen some hot reports. Those are coming in the next core. So again, if it's in sevens, that means the Fed, there's going to be a big adjustment in projection on where we're headed with rates. And then maybe over 6, well, and potentially even touching 7. If that's the case, the market's going to have to adjust for that. And that adjustment is going to look very nasty. So we see what March has. So this is March Madness. So nonetheless, again, 2 big pumps at the end of the week. I think this is, again, short covering. I think we could even potentially hit up to the 4,100. So even on Monday, if we start pushing up, it's just, again, trying to price in what could potentially be happening for the week before Tuesday's onslaught of information and data for the next couple of weeks. So that might be your little relief if we don't start selling off already on Monday, or gap down and start selling back at least to half this and get us back under the 4K mark. Could be a strong possibility. Again, we don't know how we're going to open up, but you can't just go. This push was nasty. I wasn't expecting us to keep pushing, but then as soon as the sell pressure let up, you're going to get pops. You're going to get squeezes. This is natural for a market that has a lot of sell pressure. If it can't break a level, the shorts are going to cover, and that's what you get. You get this move with the massive amount of shorts you have, and then when that event happens, that, oh yeah, so we were expecting that, and the market's bad, right? And we start, we're going to potentially have a 50-point basis move. Now, we weren't really expecting that. We're only expecting 25, 2 more 25s. Now we're expecting potentially even more than that. And looking at the 6s, and so you're going to start, you're going to get momentum shatter that level, potentially even shatter the 39 level, and see yourself back down here at 38. Again, really depending on where that core is sitting, but again, right now, in my opinion, this is all short covering. It's an anticipation waiting for this week. And again, I expected this to be more so at this point in the middle of the week, and it wasn't till the tail end. People are just covering and waiting for this next week for the next onslaught of massacre in this March Madness that we got going on. So the dollar, as we can see, the dollar has been holding very well. You definitely don't want this breaking over the 105, 55. If it does, again, your next level here is at the 107. But again, if you break this big level, I think, again, where you're going to see a new high in the dollar, a strong possibility it could reject and continue selling off. It's always a possibility, but the way things are setting up is really dependent on what Powell says, and that's what I'm saying is he moves markets. And so for whatever reason, if we have to go back to a 50-point basis move, you're going to draw a lot of fear. And that's exactly where that's going to come from. Right now, you got so much hopium fed and trying to prop up this market because things are so bad. I think in emergency bond buying, that's what's holding the market. And or else I think we'd be in a very, very bad state from where we're even currently at. And so, again, we wait and see. Bitcoin, huge drop this week, but we'll see what happens here. Again, it needs to hold the 40 or the 21K mark. If it does break that, I easily see this back down to 16, if not lower. Again, the way things are potentially planning out, this thing can come crashing down pretty quickly. I don't think 16K is the low point on this downside in this bear market. So, but we wait and see how things play out and go from there. Tesla. Like I said, Tesla had a bad investor day. It did gap down. We want to see how this does open. This could be a retest here. If Tesla can't remain above essentially the 195, could be an issue. This might just be a retest before the next dump, but it needs to hold the 183. The next level roughly being around the 166. Then you got a huge gap fill down to about the 140. I am expecting Tesla to eventually be around here around the 140. Question is where is the market going to be around when Tesla hits this level? The market's doing really bad. The market's selling heavy. You might start seeing this thing sell off, potentially down to the 100. Again, right now, if we go back to a 50-point basis move, you have to understand tech's going to get hurt the worst. That's why I have NVIDIA and Tesla on here, because they've been absolutely parabolic over the last quarter, or the last run up, essentially from the 100 mark. So I think this, whatever pullback, like I said, we get from this is going to be the bottom. What that means for individual stocks, it's hard to say. This could potentially have been the bottom for Tesla. Don't really know. Problem being is we've been propped up by value in financials. So as soon as financials get crushed, we'll see how much it takes off the top for tech this time around. So, but again, I think a recovery will happen this year in the stock market. I think you'll see your bottom in the stock market this year, and then stock market normally leads on that front, and then the recovery will happen, but it'll be very slow. It's not saying interest rates are going to come down quickly. Interest rates will be around for be high for a very prolonged period of time. So just be mindful of that. But again, we will wait and see. Things need to break much more before the rates let up. And Powell's also reiterated that multiple times. So NVIDIA, again, some heavy selling and then quick bounce back. This is the level I'm watching, is the 238. And we'll see if this actually breaks out or it breaks down. If it starts breaking down, again, I think what you may see is just the market being flat here come Monday, and then if not, gap down a little bit. If it drops step back down below the 235, that means that was just the final retest before the drop. Because you normally get this, if you see any moves, normally what happens is you get some major selling and you get one last hoorah, and then you get a massive drop. So that's kind of what we're seeing. And sometimes, a lot of time, this is kind of more the you'll get a couple of retests because people know this is a level. This is always good to see, especially when this is when institutional buying comes in, and you be very mindful of this. So you get institutions, they know this is especially because the past year has been more of short selling. There's been a lot more short sellers than there has been to the long side. So if you can imagine this on the bottom side here, this is the same kind of institutional buying, except to the downside. So what happens is you have a resistance level or a support level, and you'll get a couple attempts, it can't break. And so to get liquidity, what happens is you'll get a massive sell-off, and then you'll think, oh no, it's the reverse to get liquidity. And so you'll spike up, and that drains liquidity, or all the people that have essentially their stops in place. So the institutions know that stop is sitting below this support or resistance. And so it will drain liquidity, hit everybody's stop, and then boom, and you get the massive move. And that's what we're looking for coming into what I'm looking for coming in the next following weeks, is that you got short covering here. So this is going to draw people thinking it's going to reverse. You're going to hit liquidity because it breaks. People think it's going to break out, get all the liquidity you need, get your puts, and then bam, and then we sell off heavily. And it's the same for support, right? And going to the long side. So this is a massive support here, right? So you get the same thing, try, can't break. Then you get a spike to draw your liquidity to get filled, and then you get the pump. So that's pretty much what has very similar, and we've seen this a couple months back. I can pull this back up on the SPX. Let me pull this back up on XPX real quick. And this is something I keep reiterating right here, is this was a big support here, roughly around the 35.92. And so what you've seen of a couple attempts, it can't break. But what happens is we had the Powell event that happened right here. And so we had the Powell event, I think that happened up here. And then we had some bad data right here that essentially Again, the banks realize that this is a support. The institutions know this is a support. But to get liquidity to go to the long side, you're going to have some kind of news event or whatever the case is. And that's typically how news events play out with the technicals. And so you get a massive sell down. It fills liquidity because this was all in one day. And this thing rocketed straight out of here like 200 points. And then the next thing you saw, institutions were riding this thing all the way back up into earnings. And then now, same thing. You're going to start seeing selling like you do here. Again, you have support. You're going to get a draw into that liquidity, and then you're going to start selling off. Draw into liquidity, start selling off. That's how the market moves, right? And so, nonetheless, I think that's what we're seeing on. Is just a clear indication here on NVIDIA. Is that you have this massive support here, and this is your one last attempt to get liquidity, so you might see a little bit of a spike. It's really important to watch price action around here once it does break, and then if it starts dying off, that just means there's a draw on liquidity, and then you'll start you get massive selling after that. So we wait and see. If we would have broke this, it would have already happened, in my opinion. The fact that we went down, we pulled down really hard to get one last spike up, people are like, oh yes, draw your excitement, draw liquidity in, and then bam, and that flips on you and starts selling off. So we shall see. BA again could be the same thing here, right? We held this range for so long, and then now we're just pushing right back up, drawing liquidity, and then sell off. That's what I'm thinking is happening here. So we'll wait and see if that's the case. Moving forward into the next March Madness. And then for here, JPM, same thing. Again, it's been holding this for a very, very long time. Draw on liquidity. You'll see if we get a little spike on Monday. And then Tuesday, Powell, bam, be whatever we need to start selling off pretty heavy. But we see. So it needs to hold roughly the 144. If you want, this needs to actually break above that the candlestick needs to open up and actually break out. Otherwise, it could potentially see the 130, and again, it breaks that. Then you get some bigger selling, and something I keep emphasizing is this huge section right here, this parabolic move that's essentially happened. All in this is you're going to give this back. This isn't going to be here forever. Right, that's the way the markets work. You've had a top over here as well. You're hitting that top. For us to break out of here, you don't have a good enough reason for us to break out of here. So you might get a draw on liquidity, and then one big crash back down to 101 potentially. Again, there isn't enough good news in the market to keep us pushing up. So just be mindful of that. Goldman Sachs, again, it's just plain range. A lot of the big selling from Goldman Sachs has been comments from the CEO on recession. So every time he mentions recession, dive, recession, dive, recession, dive. It's pretty much what's been happening with Goldman Sachs. Bank of America, same kind of thing. This particular was comments on recession, massive drop, and then recession, drop. So nonetheless, that's pretty much what I got. I know this video is already very long. So with that being said, there's a lot of information coming up. So you need to be very mindful of what's going on. Again, there's nothing saying not taking advantage of these pumps, but in my opinion, again, I'll find advice. You have to sell these pumps because they are fake pumps. Again, you're holding up the market with emergency bond buying. You're short covering. That's where these moves are coming from. That's not a massive spike in demand. That's just short covering is what you're seeing. And then draw for liquidity and then massive selling. But with all that being said, drop a like, drop a comments on what you feel is currently going on in the market, your thesis. I like to understand where you're at, what you're looking for, and the potential depression that we're in, what we're trying to pull out. Again, my categories, I'm looking heavily in AI and supporting units of AI moving forward. I think are going to be a huge driver of what's going to pull us out of this thing, along with crypto. I think crypto still has to do some selling. I think there's just a lot of normalization that still needs to happen first and then we recover from that point. It's not going to be a fast recovery, but we will recover, I think, after this last leg down. So I'll let it break, let it happen. That way that the Fed could ultimately start actually reducing rates. But it's too early for that to happen. Inflation is not going to come down. We're seeing that, again, the biggest problem being is that as soon as we let up on rates, the demand comes right in, and that's not a good sign when you're trying to get inflation down to 2%. But we see, we wait and we see. With being said, go ahead and drop a like button. Until next time, I'll see you guys later.